we still have the same problem of upside down assets. And Dunnigan, we haven't even touched on the coming recession. What about the shadow banking system and all of their bad assets? How about their commercial real estate assets? Mortgage-backed securities, CMBS, residential mortgage-backed securities, junk bonds, CLOs, all that's coming. So there's going to be a lot of distressed banks, even the big ones, because of what the Federal Reserve has done and continues to do.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends. Because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always privileged to have this returning guest. Michael Pento, the founder of Pento Portfolio Strategies, an active money manager, is here with us this Thursday, April 13th, 2023. Michael, thanks for coming back on Liberty and Finance.
Always a pleasure to be with you, Mr. Kaiser.
Our viewers always look forward to your visits here because as an active money manager, you're always looking at forward-looking indicators to tell us where things are headed next. Unlike the Fed, that's only looking at trailing indicators to the largest extent and seem to be always on the wrong foot and causing as many problems as they quote-unquote solve. Right now, people are quite concerned about destruction of their wealth, destruction of the purchasing power, destruction of their savings, destruction of their retirements, and frankly, risks in the banking system. So there seem to be we're encircled with potential risks to our financial well-being. You study that on an ongoing basis, and you've talked to us over the quarters and over the years about the direction you see things heading next. Could you give us an update on where you see us in this progression of events, where we're trending currently, and what you see lying ahead?
Well, I just listened to Janet Yellen. That's who I rely on, because she's always right. She said that there'll never be another financial crisis in her lifetime. I think she's still alive, right? Still breathing, thank God for that. I'm happy to have her with us among the living. But she did say that the banking system is fine and solvent, other than the 3 banks that went bankrupt recently. The only reason why the banking crisis didn't dissolve into another 2008 global financial crisis is because the Fed opened up the discount window with this new term facility, bank term funding program. It's not QE. I call it QE light. Yes, banks are allowed to borrow at par, bring all their distressed assets to the window, this new facility. So it's keeping banks alive, but it's creating zombie banks. So there's a difference between QE and the bank term funding program. But what I want to impress upon you and your audience is why we have this crisis. Why is there a crisis coming? Is it my imagination? Is it just because I want to sell gold? I mean, what are we doing here? Are we doing real analysis, or are we trying to use hyperbole? So I'm going to use the former theory here. We're trying to do the best thing we can for our clients and for your audience. So why do we have a crisis? How am I sure there's a crisis coming? Well, leading up to the global financial crisis, the debt in this nation, total public and private debt, increased by 27%, by about $7 trillion, a little over $7 trillion. And that increase in debt was met with an increase of interest rates by then Mr. Bernanke, about 400 basis points, 425 basis points worth of rate hikes. Well, leading up to those are 3 years leading up to the global financial crisis. That's how much the debt increased, about 27%. Well, leading up to this latest banking crisis, debt increased by 26%, but by over $14 trillion. So it's virtually the same percentage increase in debt, a much greater, double the amount in nominal terms increase in debt, and the interest rate hikes that it took to break the banking system this time were 500 basis points. We did 500 basis points of rate hikes, and we're doing QT. This is why the whole artificial edifice that they built based on money printing and borrowing is about to unravel. And you could see it unraveling by the fact that they had to put in this BTFP program. It's just keeping insolvent banks alive, but turning them into zombies. So we've papered over the problem, which is what gold is. By the way, if you want to know what gold is smelling out, it's like, wait a second. We have an economy that has to be kept alive by what? By an increase in base money supply printing. It's loans. It's a loan for a year, has to be paid back, and it has to be paid back at par, even though the assets are nowhere near par. But it's still an expansion of credit and base money supply, and that's what gold is benefiting.
There's been concern for some time about zombie companies, people talking about the increased percentage of companies in the major indices that aren't not only not making a profit, but can't even do more than just service their debt. In fact, some can't even service their debt at these increased rates. But you use the term zombie banks. Help everyone understand what that is and what it signifies. So
there's 20% of the 20% of listed companies are zombies. So they have to tap the credit markets, which are closing or under a lot of distress right now, just to pay interest on existing debt. 32% of companies in the Russell 3000 are profitless. This is a very bad situation. So you asked about zombie banks. The zombie bank is a bank that is kept alive through the artificial edifice of the central bank, but is unable to expand money and credit and loans and lending to the public and to the businesses. Just simply because they know their capital is really zero. If you look at the level of their assets minus their liabilities, they're zero. So they can't. So if I'm a bank and I know that my balance sheet is upside down and I'm insolvent, but I have liquidity from the Fed, not at QE. QE is when you've taken my mortgage-backed securities, you've taken my treasuries, you've taken my junk bonds off of my balance sheet. You've given me Fed credit, and now I can go out and expand loans. That's what base money supply, Fed credit, is used for. You can make loans, you can buy bonds, and then through that conduit, you then, it tends to bring interest rates much lower, and then you can buy stocks. That's not what's happening here. You've given me a loan for up to a year that I must pay back with interest. And that's why these companies, these banks, are not going to be able to use that new credit to expand lending into the economy. That's zombies. They're alive, but they're really not effective.
Over the past month, there's been increasing concern about a flight from community banks, regional banks, smaller banks into the quote-unquote too big to fail banks. Some have even projected that is actually just one step in a multi-step cascade upwards to after you have just all the community and smaller banks allowed to die off. As Yellen said, we're only going to rescue the depositors beyond the FDIC limit if they're in a too big to systemically important bank. But even then, the systemically important banks have huge derivatives exposures, et cetera, et cetera. Do you see, or do you think it's too early to tell whether this is part of a progression of consolidation and eventually monopolization, where we're going to end up with one bank to rule them all, perhaps the Fed or the International Monetary Fund or whatever?
Well, the problem with these small banks is very evident. I mean, as a matter of fact, not even just for small banks, it's all banks, to be honest with you. If you're getting, banks this time let me just give you a little background on the problem. So banks this time around had a lot of excess reserves. They were parking at the Fed, getting interest on excess reserves. So, there used to be a time back in the day when, a bank would want to, give you a toaster, or they were trying to attract deposits as much as they can, even though a deposit is a liability to a bank. But they needed those deposits to make loans. They didn't need deposits to make loans because they had all these excess reserves. So they gave you no interest on your deposits. And then a funny thing happened. In the last couple of years, the Fed started to raise interest rates, actually not a couple of years, just a little bit over a year. Remember, it was March of 22 that they started to raise interest rates. So it's just a little bit over a year. And they raised rates so aggressively that now I'm saying, I'm saying to myself, in my own calculation, the money I had in the bank is like, what am I going to leave? And I had a lot of money in the bank. I said, I actually talked to the bank supervisor and I said, you're paying me 0.05% on my liquid deposits, so checking and savings accounts that weren't in time deposits. I'm going to take all of my money out of here, which was, again, a lot. And I said, I'm going to buy a Treasury. I can buy a 2-year Treasury yielding close to 5%. Convince me why I shouldn't do that. And he's like, do what you want. I can't do anything for you. I don't make the decisions. So I took all my money out of there. Well, everybody did the same darn thing. So there was a massive deposit flight. So you had QT running in the background, which was taking reserves from these small banks. And then you had the deposit flight, which was leading to this run on the banks. And then that caused their assets to go down further in price, right? Yield up, price down, which causes them to be insolvent. So now they sequestered into, JP Morgan, let's just say, Wells Fargo, JP Morgan, Fifth Third, you name the bank, a big bank, a tier 1 bank, Morgan Stanley. But that didn't solve the problem. We still have the same problem of upside down assets. And Dunnigan, we haven't even touched on the coming recession. What about the shadow banking system and all of their bad assets? How about their commercial real estate assets, mortgage-backed securities, CMBS, residential mortgage-backed securities, junk bonds, CLOs? All that's coming. So there's going to be a lot of distressed banks, even the big ones, because of what the Federal Reserve has done and continues to do. I think, and I've gotten it pretty accurately so far, I think they go to 5.25%, they raise in early May, and then they stop. But the damage is already done because you can't raise rates 525 basis points, so 5.25% on 60. I think the number here is, I don't have my glasses on. I wrote it down for you. It's like $64 trillion of total non-financial debt. So that's public and private non-financial debt in the United States, according to the government's own Z1 report. Okay, an increase of $14 trillion in 3 years. And you raise rates to that degree and you cause a crisis. And that's exactly what's happening.
The other thing we haven't touched on, I'd like to, if you would, is anything related to retirement. A lot of people have pension plans. There's both private company pension plans, publicly traded company pension plans, municipal and state, you name it, trade union type pension plans. There's defined benefit programs and guaranteed 7% per year payout. All of those that were clicking along so well for the past several decades. Can you talk to us about what's happening to them?
Well, $68 trillion is the number. I just was able to squint and see. $68.9 trillion in total non-financial public and private debt in this country. So that's why it's unsustainable. Listen, all of these pension plans are going to be insolvent. They're all going to be bankrupt, and they're going to be relying on Fed printing to make them solvent. That's the sad truth. I mean, they're supposed to be making 7% per annum. Well, how much did they make last year in their bond holdings? I think they lost about 20%. How much did they make last year in their stock holdings? I think they lost about 25%. The average portfolio, blended portfolio, was down 24%. And if these pension programs don't make 7-8% per year, they're insolvent. So they're way behind the 8 ball here. And I would be very hard. It's very hard for me to imagine that without the Fed's artificial support, that these institutions would still be solvent. So the question you have to ask yourself, and here's the problem. Well, what you have to say, Mr. Pento, why can't the Fed just keep on printing money? Because we have an inflation problem. We have a huge problem with inflation. Inflation was running at over 9% last year. And now it's down to 5%. Core inflation that was reported yesterday actually increased year over year. And it's still way above, more than twice the Fed's target. So if the Fed wanted to actually, let's just play this out. Suppose the Fed said, the bank term funding program is not really a lending program any longer. I'm just going to turn it into QE. I think they're going to do that, by the way. I think they're going to say, forget about the loan, forget about the interest. It's a gift. What do you think is going to happen to inflation? Who in this country is going to be fooled? Who in the country is ever going to believe that the Fed can raise the Fed funds rate above the rate of inflation in sustainable fashion and get inflation back to where it belongs, which is 0, let alone 2%? It's not going to happen. So they have a huge problem. And that's, by the way, I hate to take this back to my model, but yeah, you have to invest according to what's going on in the inflation-deflation dynamic. Because there are going to be periods of rapid deflation, recession/depression. That's where I think we're headed next. Okay? We're absolutely in disinflation. The disinflation could turn into deflation and a liquidity crisis. That danger isn't over. We still have a deep earnings recession coming, very steep earnings recession coming, an economic recession coming. And then on the other end of that, you're going to have probably a massive bout with stagflation like we never before imagined or even seen or imagined in this country.
There's emerging this food chain, at least awareness of this food chain in the financial system that you talked about, where workers get laid off because the companies are non-profitable and they have to weigh out tens of thousands of professional, white collar workers getting laid off from many big name companies. These zombie companies then having to keep reaching out for new financing to stay afloat. But the banks that they're reaching out to are also zombies, so they're having to get liquidity from the Fed, and up you go the food chain. How high do you see this whether you call it passing the buck or basically relying on deeper and deeper pockets higher up the food chain? How far do you see that going, and when does that blow up?
All the way to the Federal Reserve and to the Treasury. Janet Yellen, our favorite person, who used to be head of the Federal Reserve. So much for that wall between Treasury and Fed. There's going to be, I call it an unholy union between the Fed and Treasury, where the Treasury borrows money either indirectly or directly from the Federal Reserve and sends it out through helicopter money. We tried that experiment already, as if it's never been tried before. I think it's been tried in Weimar Germany. Hungarian Pengo suffered a little bit of a problem with that. Zimbabwe. So we know what happens whenever a central bank directly or indirectly monetizes trillions of dollars of helicopter money, which is checks from the Treasury, in this case, the Treasury, U.S. Treasury, to people, you get inflation. It isn't a mystery. I don't know why it was such a mystery to people that this happened. You didn't just create inflation on Wall Street, okay, by just giving Wall Street credit. You actually sent money, okay, to people and to businesses and forgave a bunch of loans. Of course you were going to have. Oh, by the way, you told them also don't go outside and make anything. So you had too much money chasing way too few goods, and you had a massive problem with inflation. I think you're going to go back to that. And this time around, there's talk about a central bank digital currency, which actually I find beyond aggravating, where people don't understand the power that the Fed already has, Donegan. The central bank already has tremendous power over your savings, your money. We didn't elect these people. And I don't want to pick on Joe Biden. I don't want to single out Donald Trump either. How much do these people really understand? Or any president that I can think of in recent history really understands what it means to have the purchasing power of your currency usurped by an unelected body. So you work hard, you earn $1, and the value of that dollar, the purchasing power of that dollar, is totally dependent on what the Federal Reserve does with interest rates and money supply. And then, of course, what private banks do with that, as far as their lending is concerned. So what we really need to do, it would be wonderful if we did this. We should try an experiment. Let's go back to the golden age of America, where we just tie money supply, base money supply, to the mine supply of gold, which is about 2% per annum, 1 or 2%, the increase in money supply in gold, which happens to be commensurate with long-term productivity and population growth. And you will never have another problem with inflation, intractable runaway inflation, ever again. But we're going the opposite way. We have the central bank digital currency coming, which means the Federal Reserve will have taken power of DC completely. In other words, the Federal Reserve, you'll have a wallet, a digital wallet, and the Fed can increase the money supply directly, circumventing Congress, the purse of the United States. Normally, if you want to give somebody money, if the government wants to give somebody money, they have to borrow it or tax it. But no, we don't have to do that anymore if we have the CBDC. So it's going to be very, very inflationary. It's not coming tomorrow. I'm watching it. I'm watching out for it. I think it's going to come after inflation starts to run intractable already. And then they're going to say, okay, listen, we don't want you to have the ability to take money out of the bank like I did. No more bank, no more money for you. No soup for you, no money for you. Guess what? You can either spend your money or have it in the banking system and lose X percent of the principal per annum, which is negative nominal yields. How's that for a complete autocracy and control over your money? And that's probably another reason why gold isn't doing so badly right now.
Maybe you're reaching back in your mind's eye and longing for someone closer to Andrew Jackson, whose quote is, "Gentlemen, I too have been a close observer of the doings of the Bank of the United States. I have had men watching you for a long time and am convinced that you have used the funds of the bank to speculate in the breadstuffs of the country. When you won, you divided the profits amongst you, and when you lost, you charged it to the bank. You tell me that if I take the deposits from the bank and annul its charter, I shall ruin 10,000 families. That may be true, gentlemen, but that is your sin. Should I let you go on, you will ruin 50,000 families, and that would be my sin. You are a den of vipers and thieves." Bringing his fist down on the table, "I will rout you out." Andrew Jackson, that's from Quotable Quotes.
Jackson, Jefferson, these people would, the proverbial, turning over their grave to see the state of the state of affairs today. It's absolutely disgusting.
One thing we didn't talk about amongst this cavalcade of collapsible food chain is insurance companies. A lot of these people are concerned. The deposit flight that you mentioned from small and regional banks was because of concern about lack of sufficient FDIC insurance. So that's one kind of insurance. But just insurance companies in general that are trying to cover the backsides of a lot of these banks or companies or whatever. What do you see happening in the insurance industry as this show continues?
Well, you look at the CDS spreads for a lot of these corporations, insurance companies, even the United States government itself. They're rising. Credit default swaps, which is a bet that these companies will be bankrupt, solvent, and bankrupt. Listen, let's be honest. The ultimate insurance company is the Federal Reserve. I mean, let's just take Charles Schwab, for example, the firm that I cleared through had a lot of trouble because they put a lot of their assets in long-term treasuries, which was yielding nothing. And then people went from their bank sweeps to a different kind of money market, which has treasury only, which was higher yielding. So they were upside down in their business model. So it's a big hit to earnings. It's not an existential threat. Because Schwab took all of their treasuries and put them which is, I'm sure what they did is they took all their assets and gave them to the Fed, and they received all of this credit, base money supply credit, which, by the way, Fed credit can be turned into cash. That's why it's part of the base money supply. Base money supply being physical currency in circulation and credit. Okay, it's all the same thing. So they can hold their treasuries for a year now, and there's no existential crisis for Schwab. But Schwab has insurance from the FDIC, from SIPC, and from the Lloyd's of London. But, I mean, does anybody really believe if they had to tap the Lloyd's of London insurance company that they could make good on all of the assets that the Charles Schwab has? No, they don't. It's all about the Fed. And what do? They don't have any, a magic elixir. They just dilute the supply of money, which means your purchasing power goes down, especially against hard assets. Not the way you measure the dollar against, say, the euro, even though the dollar is now recently losing ground against the euro. That's the major currency in the basket of the U.S. dollar index. It's against hard assets.
Speaking of hard assets, you've talked to us periodically over the years and over the quarters about precious metals. In the past, you've said you're waiting for certain indicators and signals to help guide you in terms of changing your model allocation percentage into those metals for yourself and your clients. What are you seeing in that regards now, and what are you looking for?
So this is how I think about gold. You should always have 5% of physical gold in your possession at all times. I don't care if it's the 70s stagflation or if it's the late 90s booms. It doesn't matter. Always have 5% of your purchasing power protected in physical gold in your possession. And then I toggle the difference of paper gold. I call it paper gold, which is miners and even these ETFs like GLD, IAU, AAAU. These are all, paper gold. They say they have the gold in your name, but it's very liquid, so it's very beneficial. So I toggle that between 0 and 20%. And we're about 12, 13% now long gold in the portfolio. And I took that position up maybe about a month or so ago. So we're enjoying this ride up higher in gold. The max is 20%. I'd like to see that max being achieved in my own portfolio after I see the non-farm payroll reports really start to take a hit. Because at that point, we know once that happens, the labor economists that sit at the Fed, that's what they myopically focus at. We just had speaking of non-farm payroll report, we just had a report, I think it was 226,000 net jobs were created, supposedly in March. But every other indicator outside of the BLS, Bureau of Labor Statistics, every other indicator, whether it's ADP or the ISM service and manufacturing port subcomponents that they have on the employment indexes, the JOLT survey, the NFIB survey, National Federation of Independent Businesses survey, they all show that the labor market has started to faction. Come on, blue. But anyway, the non-farm payroll report, which is what the Fed looks at, says, hey, wait a second, the labor market is fine. So they're going to still keep on hiking rates until that starts to break. And I think that should be, unless it's just turned into a completely political animal, that has to start cracking soon. And then that rate cuts are right around the corner. And when you're cutting rates, there's no better environment, because when nominal rates are falling in tandem with real interest rates falling, in tandem with a recession, and when you're questioning the banking system, there is no better environment for gold than that. And we're close. So I'm close to taking that 12, 13%, or more towards 20.
Michael, you always give us so much to think about and a lot of useful awareness on the forward-looking indicators that you're keeping an eye on in these turbulent times. If people want to really stay plugged into your regular, frequent writing, where should they get connected?
Before I get to that, can I just make one more point?
Sure.
I'm starting to question. I don't know if you remember, you'll recall in my other interviews, gold usually suffers in a banking and liquidity crisis. There's a truncated period of time, a condensed period of time where everybody just runs to cash and treasuries because there is a liquidity crisis. The bank's assets are tumbling. Shadow banks and banking system becomes under a lot of stress, and they just dump everything they have, and that's inclusive of gold. We may have obviated that need because of this new bank term funding principle, bank term funding program, excuse me. So it might be we just skip over that truncated period of selling of the precious metals, and then we just go straight up in the next crisis. So you have a crisis that's not really a liquidity crisis. It's a crisis of zombie corporations and zombie banks causing a steep recession, which causes a very steep earnings decline, which causes people to dump stocks. That might include gold miners, but it will not, in my view of things, affect physical gold in the same way. So if you would like to have more information about Pento Portfolio Strategies, the website is pentoport.com, and the email address for my company is mpento@pentoport.com, and the number to call is 732-772-9500. If you have about $100,000 to invest and you are a U.S. citizen, we would like to talk.
I remembered what it was I was going to ask you. For the past couple of years, we've been talking about not just the stock market bubble, bond market bubble, real estate bubble. We called it the bubble of everything, or the everything bubble. But now we're talking about zombie banks, zombie companies. Are we getting into the zombie of everything, or everything being a zombie stage of the economy?
No, well, the zombie. The only thing that what I hope would be a zombie, but is still alive and well, is the Federal Reserve and central banks and the government's ability to perform helicopter money. So that's the living being that we need to be turned into a zombie. But no, it's not the bubble that we have. We had three bubbles, triumvirate of bubbles. We had stock bubble, an equity bubble, a bond bubble, and a real estate bubble. Unprecedented bubbles in all three. We had negative yielding bonds, $17 trillion of negative yielding bonds, never before even thought of. Equities were 200% of GDP, the value of equities in the numerator and the GDP in the denominator, never before, even close to that, 200%. And real estate, if you look at home prices to income ratios, higher than they ever were before. So the real estate bubble is just starting to crack. The equity bubble is just starting to crack. The bond bubble has cracked. And I think it's just even if you think about the bond bubble going, interest rates going from 0 to 5% on the Fed funds rate, that's nothing. So prices down, yield up. That's nothing compared to what's going to happen to bond yields. Once the news gets promulgated that the Federal Reserve, it's a fact, the Federal Reserve can never adequately fight inflation and raise the Fed funds rate above inflation in order to accomplish that goal. Everybody's going to know it. It's not going to work. We're going to be living with, their target might be 5-6% inflation, and we're going to get, 15% inflation. And we hope it stops there.
Well, Michael, we're grateful always for your presence here. Folks, if you don't want to miss a single episode with Michael Pento or any of our guests, make sure you sign up for our completely free newsletter at libertyandfinance.com. Just put in your name, your email address, click submit, and make sure you confirm on the confirming email. You'll get one email per day in your inbox with our latest interviews, including all those with Michael, and our weekly specials. Michael, on behalf of all of our viewers and our team here at Liberty and Finance, thanks for joining us on Liberty and Finance.
Blessings to you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.